In 2007, a Bloomberg analyst named Mike Mayo asked Citigroup CEO a simple question during an earnings call. What happens if housing prices drop? The CEO laughed. 6 months later, Citigroup lost $90 billion. The thing about economic crises is they don't announce themselves. They don't arrive with sirens or warning labels. They slide in quietly, disguised as opportunity, wrapped in optimism, sold as the new normal. And by the time anyone realizes what's happening, the damage is already done. But here's what most people miss. Every crisis, whether it's tulip mania in the 1600s or the global financial meltdown of 2008, follows the same predictable pattern, the same 7 stages, the same cycle of euphoria, denial, and collapse. And right now, in 2026, we're watching it happen again. This isn't a history lesson. This is a blueprint. And once you see it, you can't unsee it. Stage 1. Displacement. Every crisis begins with something real, an actual innovation, a genuine shift in how the world works, something that changes the rules of the game and creates opportunity where none existed before. In the 1920s, it was electrification and the automobile. In the 1990s, the internet. In 2005, it was subprime mortgage lending and financial engineering that supposedly eliminated risk. The displacement event is legitimate. That's the trap. It gives everyone permission to believe this time is different. This time, we've unlocked a new source of wealth, a new way to grow without consequences. And maybe, for a brief moment, we have. The problem is, displacement doesn't cause crises. What happens next does. Stage 2. Boom. Once the opportunity is real, the money arrives. Not slowly, not cautiously, like a flood. Investors pile in. Venture capital flows. Banks start lending to anyone with a pulse and a pitch deck. Asset prices rise. Everyone who got in early starts looking like a genius. And that's when the psychology shifts. Because it's no longer about the fundamentals. It's about the story, the narrative, the collective delusion that prices will keep going up simply because they have been going up. In 1999, Pets.com raised $82 million to sell dog food online. The company had never turned a profit. It didn't matter. The stock soared. In 2021, a 16-year-old made $700,000 trading NFTs of pixelated rocks. People weren't buying art. They were buying the idea that someone else would pay more tomorrow. This is the boom, and it feels incredible because for a while, everyone's winning. Your neighbor's winning, your barber's winning, even your aunt who doesn't understand what blockchain means is winning. And that's when things get dangerous. Stage 3. Euphoria. This is the moment when rational thought leaves the building. Euphoria is when caution becomes career suicide, when skepticism is mocked, when the people screaming warnings are dismissed as bitter, old, or too scared to see the future. Prices are no longer tethered to reality. They're tethered to emotion, to FOMO, to the unshakable belief that the rules have changed and this time really is different. In 1999, the economist Irving Fisher declared that stocks had reached a permanently high plateau. 9 days later, the market crashed and erased 89% of its value over the next 3 years. In 2006, the median home price in Las Vegas hit $315,000. Strippers were buying 5 investment properties with no money down. Everyone knew someone getting rich flipping houses, and anyone who said it couldn't last was told they didn't understand the new economy. Euphoria doesn't just inflate prices, it warps perception. It creates an alternate reality where risk disappears and consequences are something that happens to other people. And then, quietly, something shifts. Stage 4. Profit-taking. The smart money doesn't announce when it's leaving. It doesn't send a memo or hold a press conference. It just starts selling, slowly, carefully, without making a scene. In late 2007, Goldman Sachs was publicly bullish on mortgage-backed securities. Internally, they were shorting them and calling their own products shitty deals. John Paulson made $4 billion betting against subprime mortgages while the rest of Wall Street was still selling them as safe investments. The insiders see the cracks first. They know the math doesn't work. They know the leverage is insane. They know the whole thing is built on borrowed time and borrowed money. But here's the thing. The market doesn't crash during profit-taking. It stumbles, prices plateau, momentum slows, and most people interpret this as a healthy correction, a chance to buy the dip. Because the narrative is still intact, the story still makes sense, and the crowd is still convinced they're early. They're not. Stage 5. Fear. This is where the music stops. Something breaks. A bank fails. A default happens. A fraud is exposed. And suddenly the thing everyone was ignoring becomes impossible to ignore. In 1929, it was margin calls. In 2000, it was Enron. In 2008, it was Lehman Brothers. The trigger doesn't have to be huge. It just has to be undeniable. And once fear takes hold, everything inverts. The assets everyone was buying become toxic. The loans that seemed safe become liabilities. The leverage that amplified gains now amplifies losses. Panic isn't rational. It's reflexive. People don't sell because they think the price is wrong. They sell because everyone else is selling, because liquidity is vanishing, because if they don't get out now, they might not get out at all. In September 2008, Washington Mutual collapsed in the largest bank failure in U.S. history. Customers withdrew $16 billion in 10 days, not because the bank was definitely insolvent, because they were scared it might be. Fear feeds on itself, and once it starts, it's almost impossible to stop. Stage 6. Panic. This is the free fall. Markets don't decline during panic, they disintegrate. Circuit breakers trip, trading halts, hedge funds blow up, entire asset classes become unsellable. On October 28, 1929, the Dow Jones dropped 13% in a single day. The next day, it dropped another 12%. Fortunes evaporated. Margin calls wiped out millionaires. Suicides followed. In March 2020, the S&P 500 dropped 34% in 33 days. Oil futures went negative for the first time in history. You could not give oil away. You had to pay someone to take it. Panic is indiscriminate. It doesn't matter if you were responsible. It doesn't matter if your fundamentals are strong. When the system is deleveraging, everything gets sold. And this is where governments step in. Not because they care about fairness, because they have to. Because if they don't, the entire financial system collapses and takes the real economy with it. So they intervene. Bailouts, stimulus, quantitative easing, whatever it takes to stop the bleeding. And slowly, painfully, the panic subsides. Stage 7. Capitulation. This is the quiet part, the part that doesn't make headlines. After the crash, after the bailouts, after the chaos, comes the reckoning. The long, ugly process of accepting what was lost. Capitulation is when people finally sell at the bottom, not because they want to, because they have to, because they're out of options, out of liquidity, out of hope. In 2009, the U.S. unemployment rate hit 10%. 14 million people lost their jobs. 8 million homes were foreclosed. Retirement accounts were gutted. Entire neighborhoods were abandoned. And here's the cruelest part. The people who caused the crisis rarely suffer the most. The bankers who packaged toxic mortgages got bonuses. The hedge fund managers who bet against the market got richer. The real pain lands on the people who believed the story, who bought at the top, who didn't see it coming because they weren't supposed to. Capitulation is when the cycle finally ends, when prices hit bottom, when reality replaces narrative. And then, eventually, something new emerges, a new displacement event, a new opportunity, a new story, and the cycle begins again. So where are we now? That's the question no one can answer with certainty, but the pattern is always the same, and if you know what to look for, the signs are everywhere. Unprecedented debt levels, asset prices detached from earnings, euphoria in private markets, warnings dismissed as pessimism. Maybe this time really is different, or maybe we're just further along the cycle than we'd like to admit. The thing about economic crises is they're only obvious in hindsight. In the moment, they feel like opportunity, like progress, like the future. Until they don't.